The bear case for Sanofi is centered on the concentration of risk within the Dupixent franchise, a recent string of high-profile pipeline failures, and the significant political and regulatory shifts in the U.S. market. Skeptics argue that Sanofi's valuation reflects a justified discount given the uncertainty of its post-2031 revenue profile and the unproven R&D track record of the new leadership. Concentration risk and the 2031 patent cliff. The sheer magnitude of Dupixent's success is also Sanofi's greatest vulnerability. By the end of 2025, Dupixent represented over 35% of total Sanofi's revenue. The too-big-to-replace problem. CFO François-Xavier Roger has publicly stated that the revenue lost when Dupixent loses exclusivity in 2031 will be too big to be mitigated by top-line growth alone. This admission suggests that Sanofi will inevitably face a period of revenue contraction in the early 2030s unless a truly transformative acquisition is made.
Biosimilar threats. While Sanofi's is working on lifecycle management and subcutaneous formulations, the entry of biosimilars for such a large volume product will be aggressive. The pricing erosion in the specialty care space could be more rapid than management anticipates if payers move quickly to standardize around lower-cost alternatives. Growth deceleration. As the drug reaches saturation in its primary indications, atopic dermatitis and asthma, the pace of growth will naturally moderate. This normalization could lead to a re-rating of the stock to a lower multiple as it loses its growth moniker. Late-stage pipeline attrition. The most significant headwind facing Sanofi is its inability to consistently bring late-stage assets to the finish line. The 2025-2026 period has seen several major setbacks that contributed to the board's decision to change leadership.
A series of setbacks in the late-stage pipeline during 2025 and 2026 has increased the urgency for R&D reform. Tolebrutinib, the asset failed to meet its primary endpoint in Phase 3 for primary progressive multiple sclerosis, leading to a major impairment in the fourth quarter of 2025 and weakening the neurology franchise. Venglustat, the Peridot Phase 3 study in Fabry disease failed to show superiority, limiting expansion in lysosomal storage disorders. Amlitelimab, mixed results in the Phase 3 COAST-2 study, which failed to meet a co-primary endpoint, have raised questions about its competitive profile in the atopic dermatitis market. Itepekimab, the future of this asset in COPD is uncertain after it failed one of its 2 Phase 3 trials. These failures represent billions of euros in lost R&D capital and have forced Sanofi to lean more heavily on external business development to fill the 2028-2032 pipeline gap. The market skepticism is reflected in the stock's underperformance relative to European peers like AstraZeneca and Novartis, which have had a higher hit rate in their late-stage pipelines.
U.S. Vaccine Division and geopolitical headwinds. Sanofi's vaccine division, a core pillar of its stability, is facing an unprecedented regulatory and political challenge in its largest market. The second Trump administration has signaled a fundamental shift in vaccine policy. Childhood immunization schedule changes. The CDC recently reduced its recommended universal childhood vaccinations from 17 to 11. This shift has already begun to impact immunization rates as parents and healthcare providers navigate the resulting confusion. Negative guidance for 2026. Management has warned that vaccine sales in 2026 will likely be slightly negative or at best flat, a significant departure from the historical steady growth narrative for this segment. Vaccine hesitancy. Public discourse surrounding vaccine safety in the U.S. has led to a dipping of coverage rates. For a company that relies on the predictable, high-volume nature of the U.S. vaccine market, this volatility is a major bear point.
Litigation and legal liabilities. The Zantac ranitidine litigation remains a lingering tail risk. While Sanofi settled approximately 10,000 cases for $200 to $250 million in 2024, thousands of claims remain active in state courts and through appeals. State court trials. Trials in California and Illinois continue to test Sanofi's liability for cancer claims related to NDMA contamination. Even though most jury trials have resulted in defense verdicts or mistrials, the legal expense and potential for a single outlier verdict keep a cloud over the stock. Time-barred claims. A Delaware judge recently tossed 200 lawsuits as time-barred, but the complexity of the Delaware Superior Court's docket means that litigation will likely persist into late 2026 and beyond. The bull case. catalysts for continued growth. The optimistic thesis for Sanofi is predicated on the unprecedented success of its immunology franchise, the resilience of its vaccine business, and the emerging potential of its AI-driven research platform. Proponents of the bull case argue that Sanofi's current valuation does not fully reflect the long-term cash flow potential of its newly approved indications or the strategic advantage of its market-leading pediatric portfolio.
Dupixent, dupilumab, continues to be the primary engine of value creation. In 2025, sales reached €15.7 billion, a 25.2% increase at CER. The drug's status as a pipeline in a product is substantiated by its dominance across multiple indications, including atopic dermatitis, asthma, and chronic rhinosinusitis with nasal polyps. COPD, the new growth frontier. The approval of Dupixent in the US, EU, and China as the first biologic for chronic obstructive pulmonary disease, COPD, with an eosinophilic phenotype marks a paradigm shift in the treatment of this chronic condition. With approximately 300,000 potential patients in the US alone, the COPD indication is expected to provide a multi-billion-euro tailwind to the franchise, with uptake already showing strong momentum in the fourth quarter of 2025. Market penetration and prescriber loyalty. Dupixent is now the most prescribed biologic by pulmonologists and dermatologists in the U.S. This high level of prescriber familiarity creates significant barriers to entry for competitors, as the safety profile and efficacy of the drug are well established over nearly a decade of clinical use.
Near-term catalysts. The pending regulatory decision for allergic fungal rhinosinusitis, expected in the first half of 2026, represents the 9th potential indication for the drug. The continuous expansion of the label into niche but high unmet need areas reinforces its market insulation. While Dupixent is the star, the new wave of specialty care products is beginning to contribute meaningfully to the top line. Newly launched medicines and vaccines grew 34% in 2025, reaching €5.7 billion. Altuvio. This next-generation hemophilia A therapy reached blockbuster status in 2025, with €1.2 billion in sales. Its superior clinical profile, offering high factor levels for a prolonged period with once-weekly dosing, has led to rapid adoption as patients switch from legacy factor and non-factor treatments. Beyfortus. Developed in partnership with AstraZeneca, this infant RSV antibody generated €1.8 billion in 2025. Despite supply chain complexities in early 2024, the product has now been launched in over 45 countries and is established as the standard of care for neonatal RSV protection.
Ivacat. Acquired through the Blueprint Medicines deal, Ivacat achieved $725 million in pro forma sales in 2025 for systemic mastocytosis. Analysts project sales to reach $1.1 billion by 2027, providing a stable revenue stream in the rare disease space. The vaccine business, though facing temporary headwinds in the U.S., remains a high barrier to entry moat for Sanofi. In 2025, total vaccine sales reached €7.9 billion. The bull case emphasizes Sanofi's ability to defend its market share in the high-value influenza segment through Fluzone High-Dose and Flublok, which are tailored for the aging population and command higher margins than standard flu shots. Furthermore, the acquisition of Dynavax and ViceBio adds critical assets in shingles, RSV, and hepatitis B, positioning Sanofi to capitalize on the next wave of immunization technology. AI and digital R&D transformation. A distinct component of Sanofi's bull case is its industry-leading adoption of artificial intelligence. Under the leadership of outgoing CEO Paul Hudson, the group committed to becoming fully powered by AI. Operational efficiency. The Play internal platform has been integrated across all global operations, providing real-time data for supply chain management and clinical trial site selection.
Drug discovery acceleration. Strategic alliances with OpenAI, Biomap, and Erindil Labs, a $2.56 billion deal, focus on generative drug design for autoimmune therapies. These technologies aim to reduce the timeline from target identification to clinical candidates, potentially increasing the success rate of early-stage assets. Clinical simulation. By leveraging digital twin technology from QuantHealth, Sanofi is simulating clinical trials to optimize protocol design, which may help avoid the costly late-stage failures that have historically burdened the R&D budget. Company Deep Dive. The structural evolution of Sanofi reached its zenith in early 2025 with the divestment of a 50% controlling stake in Opella to Clayton, Dubilier & Rice. This transaction, which valued the consumer business at approximately 16 billion euros, provided the group with approximately 10 billion euros in net cash proceeds. The implications of this move extend beyond mere liquidity. It represents a total commitment to the high-risk, high-reward cycle of innovative medicine. By shedding the steady, low-growth cash flows of consumer products like Allegra and Doliprane, Sanofi has signaled to the market that its valuation should henceforth be tethered to its R&D productivity and specialty care expansion.
The rationale for this divestment aligns with broader industry trends, as seen with Johnson & Johnson's spin-off of Kenvue and GSK's creation of Haleon. For Sanofi, the move was intended to unlock up to 2 billion euros in cost savings to be reinvested directly into the biopharma engine. The strategic focus is now concentrated on immunology, neurology, and rare diseases, where Sanofi believes it can achieve market-leading positions through both internal discovery and aggressive bolt-on acquisitions. The deployment of the Opella proceeds and Sanofi's robust free cash flow generation has been a central pillar of management's communication with shareholders. In 2025, Sanofi completed a 5 billion euro share buyback program and has proposed a dividend increase for the 31st consecutive year, set at €4.12 per share. The Sanofi's capital allocation and shareholder return profile for the 2025 fiscal year and early 2026 includes the following key outcomes. Opella divestment proceeds. 10.4 billion euros has been successfully deployed or earmarked for strategic M&A and R&D activities. Share buybacks. Following the completion of a 5 billion euro program in 2025, Sanofi has planned and mandated a further 1 billion euro buyback for the 2026 fiscal year.
Dividend growth. The proposed dividend of €4.12 represents a 5.1% increase, marking the 31st consecutive year of growth. Net debt position. As of year-end 2025, the group's net debt stood at 11 billion euro. This discipline in capital returns serves as a buffer against equity volatility, providing a tangible yield for investors while the group navigates its pipeline transitions. The decision to execute a further 1 billion euro buyback in 2026 suggests confidence in the underlying cash-generating power of the current portfolio, even as R&D expenses are projected to rise moderately to support new Phase 3 starts. Financial performance. Analyzing the 2025 fiscal results. The financial results for the 2025 fiscal year confirmed that the commercial engine is performing at the upper end of its guidance range. Total net sales reached 43,626 million euros, a growth of 9.9% at constant exchange rates, CER. This performance was particularly strong in the fourth quarter, where sales growth accelerated to 13.3% CER, driven by the expansion of Dupixent and the scaling of new launches like Altuvio and Beyfortus.
The FY 2025 results show operational momentum, though reported figures were impacted by currency effects. Net sales. Total sales reached 43,626 million euros, reflecting a 6.2% reported increase and 9.9% growth at constant exchange rates. Business EPS. Earnings per share reached €7.83, a 10% increase, 15% at CER. Free cash flow. Generation was particularly robust, increasing 35.8% to 8,089 million euros. The discrepancy between actual and CER growth underscores the persistent impact of currency volatility, with the euro's performance against the US dollar and various emerging market currencies creating a nearly 4 percentage point headwind. Nevertheless, the business operating income, BOI margin, reached 27.8%, reflecting operational efficiencies gained through the divestment and a favorable product mix shift toward higher-margin specialty care products. Valuation and sector benchmarking. As of February 2026, the group's valuation reflects a sector-leading dividend yield but a persistent discount on forward earnings compared to its peers.
Sanofi's valuation as of February 2026 remains lower than its primary biopharma peers. Sanofi trades at 13.2x forward PE, an EV/revenue of 2.3x, and a PEG ratio of 1.3x. Merck carries a higher forward PE of 16.5x and an EV/revenue of 4.5x. AstraZeneca commands a premium 19.5x forward PE and an EV/revenue of 4.8x. Sanofi is trading below its future cash flow value estimate, according to some DCF models, which suggests a value opportunity if management can stabilize the R&D engine.
However, the 13.2x PE ratio is a 19% decrease compared to its own 12-month average, highlighting the recent erosion in investor confidence following the pipeline setbacks and the CEO ouster.
The U.S. policy landscape. The U.S. market contributes roughly 45–50% of Sanofi's total revenue, making it the single most important variable for the stock. The transition to the second Trump administration has introduced two primary risks: vaccine policy and drug pricing reform. The overhaul of the panel guiding U.S. vaccine recommendations has increased vaccine hesitancy. For Sanofi, the risk is not just a reduction in recommended shots, but a potential change in the evidence-based framework used to approve new vaccines. In December 2025, Sanofi reached an agreement with the U.S. government to lower medicine costs while strengthening innovation. This agreement is likely a response to the Inflation Reduction Act's drug price negotiation provisions. For Sanofi, the risk is that the ceiling for pricing in the U.S. will continue to lower, particularly for products that have been on the market for several years, like Dupixent. Sanofi's focus on specialty medicines and orphan drugs is a strategic attempt to insulate itself from broad market price caps, as these categories typically have more pricing protection.
Conclusion. Sanofi stands as a paradox of high commercial performance and deep structural uncertainty. The bull case is anchored in a formidable reality. Sanofi owns one of the most successful biologics in history, possesses a high-growth new wave of specialty products, and has a clean balance sheet with over 10 billion euros in capital ready for deployment. The 31-year dividend growth streak and the aggressive share buyback programs provide a significant floor for the valuation, making it one of the most attractive income-generating plays in the pharmaceutical sector. However, the bear case is equally grounded in data. The concentration of revenue in Dupixent creates a massive strategic risk as the 2031 patent cliff approaches. The recent late-stage failures in neurology and rare diseases suggest an R&D organization that is struggling to deliver the next generation of blockbusters. The stock is likely to remain in its current trading range, underperforming its more diversified European peers, but offering a resilient, cash-rich alternative for defensive portfolios. Sanofi's transformation into a pure-play biopharma is complete, but the harder task of proving its long-term innovation credentials has only just begun.